Well, the S&P 500 hit more record highs this year than ever before. I'm Lisa Bernhard with Reuters, and joining me is Sam Stovall. He is Chief Investment Strategist at CFRA Research. Sam, the S&P 500 has hit 7 all-time record highs this year, and it's only early February. You study market trends very well. What does this mean for 2024?
Well, Lisa, what it means is that if we maintain this pace, we could end up with 72 new highs, and that would be third on the list since 1954, which was when the S&P finally closed above the pre-crash of 1929 high. So it could end up being a very good year, and also implies that the year itself might be positive.
So tell us more specifically about why this would make it a great year.
Well, since 1954, the S&P 500 gained 9.2% on average and rose in price 73% of the time. But I guess because we get a running start when we have new all-time highs in both January and February, the average return jumped from 9.2 up to 15.8%. And the frequency of advance, or what I call the batting average, rose to 88% of the years rather than the 73% that we have seen for all years since 1954. So essentially what it implies is that investors are willing to put their money to work very early in this new year.
Okay, well, today it does not look like the S&P 500 is going to hit another high because U.S. Fed Chair Jerome Powell gave an interview to 60 Minutes last night, which was actually taped before the big jobs report this past Friday, in which he indicated that the Fed is in no hurry to lower interest rates, and that seems to have put a damper on stocks today. So does that also then put a damper on the potential for those record highs for the S&P for the coming year?
I think it certainly puts a damper on potential, but I still think that record highs will be reached as the year progresses. Maybe it ends up where we have a lower than 15.8% gain for 2024. But I think what is happening is that investors are reacting to reality. I think the Fed's new mantra should be later and fewer, meaning that they're going to start cutting rates later than Wall Street is anticipating, not in March, not even possibly in May, but rather in June, as was implied in the 60 Minutes interview, because he said late in the second quarter is when they think they will start cutting rates. We also think that they will cut rates only 3 times by 25 basis points each. So rather than the 4, 5, 6 rate cuts that Wall Street is currently anticipating, the Fed is basically saying not so fast. And in many ways, that's a good thing, because if the Fed were to start cutting rates earlier and more dramatically, the implication is that the economy is really weakening, likely to fall into a sharp recession, and therefore needs these cuts in order to be supported.
Inflation and jobs data, which we had a slew of last week, are the obvious reports to watch. What else do you think that investors should be looking at closely?
Well, I think a lot of the indicators, like the purchasing managers indicators, the Institute for Supply Management, et cetera, that focus on not only manufacturing but also services. I think that's something that investors are looking at, because they're at or below the pivotal 50 level, which implies contraction in the overall economy. Leading economic indicators is something that's been in negative territory year on year for quite some time, and that traditionally has led to or pointed to a recession down the road. So I think investors are looking at, in a sense, a dichotomy in terms of this economy, where from a retail and from a jobs picture, things look rosy, but from a manufacturing and services perspective, things are starting to weaken.